Hello, Jim here. Today I want to talk about two things. The first is what's going on in the markets. The Fed made their announcement and the market didn't like it. It was down big time yesterday, and again, it ended the day down. So I'm going to talk about what I'm doing to deal with this kind of a market. And then I also want to share with you how I did last month. I had a really good November, and I want to share the trades with you. So be sure you stay until the end where I'll go over the specifics on not just my trades, but also how I did with dividends and interest for the month. So let's go ahead and jump right in. Okay, to start out, let's just have a quick market update. I was really surprised that the market reacted so negatively to what Powell had to say. I kind of expected that they weren't going to cut rates as much next year. He indicated two cuts potentially, and some concerns about both inflation and unemployment, which I've noticed myself. I've noticed that the numbers just aren't quite there, and I don't know if they really need to cut too much. At least that's my opinion. Now the market didn't like it; it dove big time yesterday, and it was down by the end of the day today. What am I doing to deal with it? I do have several names that are fairly deep in the money. I'm planning to probably roll those down and out. I'm probably going to move some things around in my portfolio, especially with a lot of the chip makers. They've just been hammered majorly, like AMD, Micron, which I talked about in a previous video. I'm looking at rolling them down. I might convert a vertical put credit spread into a cash secured put. I believe Micron is truly a good buy now. They reported earnings yesterday and their guidance was pretty bad, but their earnings weren't bad. They just had redid their forecast, and it was much lower than what was originally expected, at least for next quarter. But overall, I think they're dirt cheap, and I do believe that they still have a lot of potential and quite a bit of growth. So I'm looking probably to take a little bit more risk with them. And in some of my other positions that are fairly deep in the money, in some cases, I may take a little bit of a loss to roll down lower, or I might, take a loss if need be with particular names. One I've talked about before is ACLS. I took probably a $1,500 loss, and I'm going to go ahead and put those shares to someone else and go ahead and take that loss. I can use the cash for something else. Typically, when chip makers go through a rough period, most of them they kind of follow suit. Pretty much all the companies have a similar impact, but just as along the lines of, when they have a rough time, it can turn around in an instant and they can do a lot better. I think a lot of the uncertainty about the tariffs and what might happen with the tariffs, it's kind of impacting the chip makers, like AMD, Intel, Micron, Qualcomm, all the big names have been hit pretty hard. So just wanted to mention that. I was doing this vertical put credit spread wheel trade, and I'm going to start probably changing that a little bit because some of these positions, probably too much. I was too much in the chip makers, especially Micron and AMD. So I'm going to look at managing those trades like I typically have in the past. Again, rolling out and down. If I have to convert a vertical put credit spread to a cash secured put, then I will. And then really digging deeper and being sure nothing fundamentally have changed with either of these companies. And I don't believe so. I just believe that the market's kind of going through a transition period, which it typically does. If you look at any of these stocks, sometimes they hit lower lows, and then at some point they turn around and then they rebound pretty significantly. And that's what I'm thinking is going to happen, especially with Micron. I think it got down to like 86 or 87 today. I wouldn't be surprised within the next week or two that it bounces and gets back into the mid 90s, high 90s. So at least my 2 cents, and it may only be worth 2 cents. So now the other thing I wanted to talk about was, by trading options or selling options, and then earning good interest and dividends on your accounts, you can end up doing better, especially if you are just buying stocks and you're not, selling options or trading options. You potentially could end up having a bigger impact. For instance, with any of these companies I just mentioned, Micron or AMD, if you had just purchased them instead of selling a put on them, you would have paid more and probably taken a bigger loss. This just kind of comes with the territory. A lot of times the markets will dive and then they'll recover, then they'll dive again. I've been through it all. 22 was kind of a rough year, but I was also went through, 3 or 4 other recessions, 207 and 208, 99. I remember, how things really dove in 99. Are we going to have a similar thing? I don't particularly think so. I think once the Trump administration takes over and some of these fears related to tariffs go away, I do think things will calm down. I do believe we're in a bit of a bubble with AI. I think some of those companies will be hit potentially. Once the bubble bursts, they probably will come down to a meaningful PE or meaningful value. Again, right now, some of them are still way overvalued, and not the companies like Micron and AMD is still a little bit pricey. I do believe around 120 it's fairly priced, but it's not cheap by any stretch of the imagination. So, but by trading, by selling options and have premium from covered calls and premium from cash secured puts and vertical put credit spreads, you end up generating a lot of income. And then, one thing that a lot of people probably are overlooking too is a lot of the covered calls with the market diving like this become very profitable, and you can potentially close them which will set you up nicely for when the market does rebound and some of these companies regain some of the value that they've lost. So I've been able to make some covered call trades in the last day or two, and some of them have become fairly profitable. I actually had some covered calls on some Micron that I already owned that now is out of the money, and it was way deep in the money not long ago. So having a balance of, calls and puts can be helpful when you have, when the market goes up so high and your puts become very profitable, or the market takes a dive like it has recently, and then your calls become very profitable. So having a balance really does make a difference. And it's really like multiple income streams. It's like, you're earning interest. That's why I have most of my trading occurs, especially with puts in Fidelity, because they have the sweep account and it pays really good interest. So I end up earning quite a bit of interest with that. Plus, I have a lot of stocks that pay fairly good dividends. So between the dividends and the interest, it becomes quite a bit. And then when you add on call premium, put premium, and then even more complex strategy like iron condors and vertical put credit spreads and strangles and straddles, you can really bring in quite a bit of income. What I encourage people, especially if this is one of your first downturns, you're new to trading options, is stick with it, because what happens is you get burned once or twice and you start thinking down along the lines of you want to give up. And that's probably the worst thing you can do. So I've been trading today. I've made several trades, and I'm going to continue. And when the market dives even more, if it does dive more, it'll be even more opportunities for making additional cash secured puts and vertical put credit spreads. Again, in my mind, the market has been pretty pricey recently, and it's been hard to find good trades, especially put related trades. So just wanted to mention that, and then stick to a risk management plan. So I have my planning worksheet that I share with my membership, where I know what I need to manage trade-wise. I know trades that are expiring soon are more important to manage than, something that may be 2, 3, 4 months out. Also, the deeper it is in the money, the more likely it would be early assigned. So those positions need to be managed a little bit earlier. I like to look at around 10% in the money. I looked at all my trades over the last 2 or 3 years, and typically there's exceptions to the rule, but if it was more than 10% in the money, meaning if you had a $100 strike and the current stock price was 90, then suddenly that position had a very large chance or very big chance of being assigned early. So that's something also I keep track of. If something's $2 or $3 in the money, I won't necessarily worry about it. But when it's $10, $15, $20 deep in the money, then I start becoming concerned and decide that I really want to manage it. So it really does make a difference. And then, when the market's really pricey, I take a lower delta for my puts. When it's, when we've had a major correction and the market's cheap, then I'll take a little bit more risk with my puts and less risk with the calls, because one of the issues you have is you get a correction and maybe you take ownership of some stocks, then you start selling some covered call to try to make a profit, but then you end up with covered calls that are deep in the money, and that's something else you want to avoid. So if the market has corrected and it's, bargain prices, just be careful selling covered calls. I'd almost suggest to wait until the market's had a chance to recover, or those particular positions had a chance to recover, before you start selling covered calls. And always sell covered calls above your cost basis. I suggest kind of looking and saying, well, I'd like to earn 10% above my cost basis, and don't sell covered calls until you can reach that point, or an even higher point. Maybe you say 15%. So just something to keep in mind during these kind of crazy time. Risk management is really important. So that being said, let's jump into the next part of the video where I'll share with you my trades. Okay, here's my November trades. I pretty much took my planning worksheet from November and just deleted all the positions that I did not trade in November. So I like to color code things. I like to pretty much organize things by expiration, but I've listed them here by when I made the trade. So I did a trade on Google. I did a roll. I have liked to trade on Google recently. I've brought in a lot of premium with Google. So in this case, I brought in 261. Total, I brought in 499 for this trade, and which is like 112% return. I have two different columns. I have capital required. I also have this assignment coverage. I might end up getting away from that. I do think it sometimes confuses people. What's important is the capital required by buying the put. So buying this long strike, this 150 put, you're protected on the downside. So that put is always worth something. So the required capital is more based on that. So it was 160, 150. And like I said before, I've done a lot of trades with Google and it's worked out pretty well. Here's Micron. I've been trading Micron a long time, so I know I did that video last week. And Micron's taken a dive because of earnings, but I think they've been one of the best companies I've been able to trade with. So I think this is a little, they're probably going to bounce back fairly quickly. I'd be surprised within a couple weeks if they're not back in the 90s or maybe even the low hundreds. So this is a trade I did on November 1st. It was also a roll, 90.80. Or was it a new one? No, it was also a roll. And I rolled it out to December. Brought in 288. They always seem to have really good premium. And this is like a yearly return of 126. A required capital of 1711, which is just this 288 minus, or 2000 minus 288.68. And then I did Twillo. I've closed those recently. Twillo shot through the roof, so all my puts I was able to close. Fiverr, this is another trade that I've been doing recently. This is 4 vertical put credit spreads on Twillo, and it worked out well so far. It looks like it should expire. I still have this, so it'll probably expire, but I brought in some pretty good premium, 294.57, which is almost like 130% return, and it was expiring. When was it expiring? I think 12/20. Yeah, so that one's expiring soon. Another one I closed, GPN, that I believe is Global Payment Systems, 90.80. Then Airbnb, I was able to roll it, a covered call at 130. And I believe I went up. Now, this is one of those cases. Yeah, I rolled it up to 140. Now, Airbnb got hit pretty hard yesterday. So it's probably, I think it got down to as low as 128, 127. So this covered call is probably very profitable. I can probably close it, which will be nice. Intel, another covered call that I rolled. Intel's had a rough time. So I rolled this down from 45 to 37 and brought in 294 in premium. This is for 4 contracts. So I do think they will probably rebound. I like Intel. I like their chips. So at least I'm hoping they will. Like I said, I own 400 shares. I'd like to see them bounce back. XLK, this is a ETF that's related to the technology sector, and it worked out really well. 215, 205, 19 delta, and I made some $241. So I was able to close it. XLE, a lot of the ETFs, what I found is I've been able to close them and do quite well. So I closed another vertical put credit spread, an XLE, 23 delta. Applied Materials also expired, 175, 165, and 18 delta. Brought in 173, so a little bit less for that one. In NVIDIA, this was a call spread. The put side I ended up closing because they went through the roof. But now the call spread, I ended up rolling up and out, brought in quite a bit of income. Let's see, and I think I'll be able to close this one too with the recent turn in the market, but I brought in 192. It's almost like a 49% return, but I should be able to close that one, which will be a relief. Qualcomm, this was a new one back on 11/8, 155, 145, 1220, and I've rolled it again since then, but it brought in some pretty good premium. Originally 289, almost like 150% return. So part of the reason I like the chip companies is they do bring in a lot of premium. I did have Truist get assigned away from me. This is one of the first ones that's been assigned away from me. So I did bring in the cash, and I'm looking to potentially start trading some within Thinkorswim and build up more cash within my Schwab account, looking to do more trading back on Schwab PayPal. This was another roll, covered call, 75. And again, I went up to 90 because it shot through the roof. So this is probably another one that might have come down. I have not looked at PayPal recently. Square, this was a cash secured put wheel that closed. It was very, very profitable. Con Edison, this was a covered call roll, and it's been in the money for years. I just keep rolling it. And it usually will get up into the mid 90s, then drop back into the high 80s. So, and it pays a pretty good dividend. This is Tapestry, another one that I was able to close. It got pretty deep in the money. And so another example, sometimes, stocks will go in and out of the money. If you panic and close them too quickly, you kind of force yourself to have a loss. Plus, Tapestry is a good company. I believe it's gone up into the mid 50s now, or low 50s. This is Agilent. I'm not sure if I pronounced that right. It was an IRA roll, 135, 130, so it's smaller spread. It was 136 at the time, and I rolled it to 135, 125. So I widened it a little bit and brought in 415 in premium. So one of my better trades, 259%. And it's worked out well. It's currently maybe a little bit in the money. So I believe it's in January, the expiration now. So this was my big painful assignment, ACLS. This is a chip maker primarily for the EV market. And they've just been hammered. They keep hitting new lows. Here you can see 110.95, and I believe they're currently right around $60. I still have the long put. They got assigned to me at 110, but I still have the long put, which will lock in a loss for me. This is one of the few losses of 1541, which right now with what's going on in the market, I'm going to let that long put fire off on Friday and get those shares assigned to someone else so I can get the cash back in my account and start trading something else. IJH, another ETF that's worked out well. I rolled it 61. I believe I went up to 63. Yeah, 63. And I brought in not a whole lot of premium, $65. And that was primarily to roll it up. I believe right now IJH is right around that same, right around 63. Williams Sonoma, one of my favorites, I was able to close it. It also got deep in the money at one point, but I was able to close it. Then Chewy, I've enjoyed trading Chewy. This was a cash secured put wheel, and it expired out of the money. IJH also got assigned away from me, so I did have a few positions assigned away from me. It was definitely fairly profitable. I'm looking to pick up some more, and I still own quite a bit of IJH. This is again Intel, another covered call. This was the 37. I rolled it again. Yeah, actually, that's a different one. That's one contract in a different account. So I have 500 shares. And what did I get for that? I brought in, I believe, 308, but it also expired. Pins. It was assigned to me. This is one of my cash secured put wheels, monthly wheels. And it was assigned to me at 33. My cost basis was right at 204. So my cost basis is like 31. I later sold a covered call on it and brought in, I think, $58. So it's still a fairly profitable trade. But again, it dropped yesterday and today. So the current covered call will probably expire. Palantir, this was purchase put that I was thinking that they would drop, but they didn't. This purchasing puts and even purchasing calls haven't worked out real well. So I wasted 268. And I recently just wasted probably close to $800 on a call I purchased on Micron, thinking it would have good earnings. So learned the hard way not to do that. And even when I shared it with my community, I mentioned that was a possibility. If they had bad earnings, it could be a complete loss. And I've found buying calls and even buying puts don't necessarily work very well. I probably won't do it anymore. Fiverr, this is a Fidelity IRA. In my Fidelity IRA, this is a vertical put credit spread that I did. I'm missing half of it, but I brought in 105. I believe this was a cash secured put versus a vertical put credit square. Versus a vertical put credit spread. Square also closed it. It shot through the roof, so I was able to close a $60 cash secured put on it. XLE, another one, I was able to close it for cheap. In some ways, it's a lot safer just to stick to ETFs than dealing with some of these companies. Applied Materials, this is another one that was a new one, a vertical put credit spread, 150, 140, 19 delta. It was 173 at the time, and they've also come down quite a bit, I believe. But I brought in 303, required capital 1696. It's 2,000 minus the 303. It's like an 111% return. So where are we? 1119. So Dell. This is one that I managed. It also got deep in the money a while back, and I converted it from a vertical put credit spread to a cash secured put. So I sold the long put, brought in some good cash, and then when I rolled it, I also sold a much lower cash secured put, which allowed me to get it out of the money. And I've done that recently. It works out quite well. So this time I rolled it up to 115 and brought in another $400 in cash. So I brought in almost $2,500 since I started this trade back in July. So my cost basis, if those were assigned to me, would probably be in the 90s, mid 90s probably. Bluebird, another company I really like. This was a Roth IRA. Still have it. It's probably going to expire tomorrow, I believe, unless they dove big time. But I believe even if they dove, they may be above 35. But a good company, high productivity, really nice return on equity and return on assets. They make the yellow school buses. So let's see how much I brought in with this trade. So I brought in 368, so not bad. And this again was a cash secured put. So, and it was also part of my wheel trade. I didn't mention it there, but it was definitely part of my cash secured monthly wheel trade. And then Broadcom, Boy, I wish I had been assigned some of these. They did have good earnings. That's partly why I thought Micron might shoot up, that they might have similar earnings. But Micron actually had okay earnings. It was the guidance that really caused them to get hit hard. So this was a roll. I did a 1 week roll. I was rolling Broadcom weekly, brought in some pretty good premium, 138, almost like 180% return. This is Lamb Research. Rolled it for 2 weeks out, 72.50, 65. I kept the same strikes. Brought in 470.39. Again, really good premium with a lot of these chip making companies or software companies. I believe Lam Research is also a chip maker. And this was almost like a 725% return, 434 for the second trade. So I did these weeklies. Now it became a lot harder with what went on with the market yesterday. Micron, same thing, 1121. This trade, I rolled it, but this was before the market tanked. So this is one of the trades I will manage and deal with and roll it out and way down probably. Micron dropped into the high 80s or mid 80s. So I brought in some pretty good premium, 634. And this was a really good return, almost like 700. And these are the ones I'm doing like every week or two. I've done other videos on them. So Coca-Cola, I'll try to do a roll at least every month. And this was just 2 contracts, and I brought in 281. And it's like a 3% return, but my cost basis is so low with my Coca-Cola. If I used a true cost basis, which is probably a tenth of that, the return would be a lot higher. So NVIDIA, this is in my Fidelity IRA, this is a vertical put credit spread that I did. And this was pretty far outside the money at one point, but now with even NVIDIA dropping, it's only about $10 out of the money, or maybe less, depending on what happened in the market today. 243, NVIDIA always has good premium. 95% return. I believe I took less risk on this at the time I did it, which now looking back, 16 delta was probably fairly wise. Procter & Gamble, I rolled. This is a covered call. I rolled it up and out. This is another scenario I can probably, it may be out of the money now, but I rolled it up to 185. Brought in some pretty good premium, 338, which is like a 4% return, but I went way out, 115.27, so it was a leap. At that time, I believe it was way up. I believe it got up to close to 200. Pins, this is in my Fidelity IRA. This is a covered call. This is the one I did it after it had gotten assigned to me and brought in some pretty good premium. I think it was only $58, but that's for only one contract. And then FCX, it was in the money earlier. I guess at this time it was in the money, 11/26. This was another one of my wheel trades, 42. Brought in pretty good premium. These are monthly trades. So I do them like once a month, but if you can earn 32% on a monthly basis, that's pretty good. And brought in 170 and 65 in premium. IWM, another one I closed. I've done a lot of IWM trades over the years, and none have ever gotten assigned to me. So if the market continues to drop, I'll get back into doing the Russell 2000 IWM trades more often. This was Mara. I've done really well with Mara and kept it around this 1713 level. I might have, I went to 1915. They went way up, but I brought in 529 and I brought in over almost $2,000 since I started making this trade. And it had a really good return, almost 354%, primarily because of the spread. And then HIMS is another one that expired. And now they've come down recently. They might be maybe a good time to make another trade on them. I do like them. They have really good profitability and no debt. So those are the trades that I did. Now the summary I did, we'll come over here to the right. I did 11 covered calls. I did 12 cash secured puts, 20 vertical put credit spreads, one iron condor for a total of 44. Now, some of those are closed trades, trades that I closed. So I brought in 83.95. This is just call, put and call premium. My required capital was 173,228. So it's almost like a 4.85% return monthly. Now that's not the total value of my account, but that's the capital that's been required to make these trades. So it's an average premium of 190, daily premium of almost $400. Yeah, I don't know. That doesn't seem right. I think I just added those two together. 562. Oh no, 562 is based on the dividends and interest. So when you include dividends and interest, it's 562.08. Now we can come over here. So my Schwab brokerages, the trades I did in Schwab ended up only being a small percentage. So it's like 0.21% monthly. So it's 1240 is what I made. And it's based on, so here you can see my value, 577 is what the value is in those two accounts. So I haven't been trading as much in my Schwab accounts, but that's probably going to change. I'm going to try to get this up to maybe closer to 1% a month. Now my Fidelity, where I do most of my puts, it's almost like a 1.46%, which is almost 18% a year, which works out quite nicely. Now, of course, when you have a market downturn like we've had in the last couple of days, then the numbers will come down quite a bit. But I found long term I do better when I am selling options. When I compared myself to, I had a financial advisor, I did better than the financial advisor. And I compared my, especially the accounts I traded in, I compared that to my 401k and I did significantly better in my own accounts. So total premium, this is what I brought in, which when you add in all my accounts, which is a little bit over a million, almost 1,000,004, it's like 80.81% on a monthly basis, or almost 10%, which I've had higher months than this. But again, I have a lot of invested stocks, so I only have so much cash, and I potentially could do more. I typically do 1 to 2 trades a day, and then I'm done because I'm still working. Like today, I had a bunch of client calls and was doing a lot of software coding, so I didn't have a whole lot of time. So the total income, which includes the interest and dividends, which is 3408, is what it was, or typically that's the average on a monthly basis, brings me to 11803 for November, which again, if you're going to look at it on a percentage basis, it's almost like a 13.66% just for that, which can be fairly significant, or for everything added together. And that doesn't include any appreciation or depreciation, meaning if like Intel lost 50% of their value. So, and just some notes, a good number of trades were closed or expired. 16 in total were closed. So total trades is more like 29. So for November, because of Thanksgiving and holidays, I really stuck to around a 1 trade a day. I did only 8 new trades, and I have, at the end of the month, I had 75 active trades. Second month in a row, I've lowered the total positions. So good month overall. The big issue, and I like to show it up here, was the 1541 loss with ACLS. And you're going to have those if you trade enough. ACLS went way in the money and came back out, and then went, it did that a number of times. And, it's one I would have thought would have bounced back, but, especially with Tesla doing so well, but they haven't. They keep hitting lower lows. So at least for now, I'm planning to put those shares to someone else and go ahead and take that loss. But when you're bringing in a lot of premium, if I just had an account with no premium coming in, that could be fairly substantial. So that's what I wanted to share with you guys. Let me know what you think. Would you do something differently? How do you deal with stocks that go against you? How do you, do you sell them right away, or One of my big mistakes over the years is probably holding on to some dogs way too long, and I'm trying to not to do that anymore. So let me know what your thoughts are. I try to respond to almost all my comments within 24 hours. And sorry if I went on a little bit long. I sometimes will get a little bit wordy. But again, thanks for taking the time to watch the video.